Kia ora, and welcome to the CoreLogic Property Market Update for Haki here, December 2022. As the end of the year draws near, we can now pull together a comprehensive view of the 2022 downturn, one we dubbed the year of the buyer's market. That certainly turned out to be true, as vendors found themselves with fewer buyers to negotiate with and greater competition in the form of more properties being listed for sale. Reduced demand, increased supply, and waning confidence led to stubborn vendors holding out for what became unrealistic prices, further boosting supply and blowing out the average days to sell. Ultimately though, with little motivation to drop their price too far, we had a standoff, leading to more properties on the market and sales turnover reducing significantly. Sales transactions slowed so far that we're looking at closing the year out only marginally ahead of the lows of the global financial crisis, at around 65,000 properties changing hands. Of course, along with the upper hand shifting to buyers throughout the year and transactions being drawn out, we saw values fall accordingly. According to the CoreLogic House Price Index, nationwide values are now 8.1% below their peak and likely have a way to go yet, with the consensus peak to trough forecast sitting in the -18 to -22% range. Te Upoko or Te Ika a Maui, the Wellington region, has been hit the hardest through the cycle, with both Te Awa Kairangi ki Uta, Upper Hutt, and Te Awa Kairangi ki Tai, Lower Hutt, down 20% on peak, and Porirua not much better at -18%. Elsewhere, double-digit falls have been registered in Tamaki Makaurau, Auckland, Te Matau a Maui, the Hawke's Bay, Whanganui, Papaoia, Palmerston North, the Kapiti Coast, and Wairarapa. It is worth acknowledging that for many, this is only reversing a portion of the exceptional growth witnessed through the pandemic. Values in Aotearoa, New Zealand grew 41% over a 19-month period. In Te Awa Kairangi ki Uta, Upper Hutt, values increased by 50%. And in Whanganui, the growth phase was slightly longer at 21 months. By then, values were 55% higher. So while the falls in values over the past year have helped bring some properties back into budget for more first home buyers, affordability is still significantly stretched. Mortgage interest rates have been central to the property market's weakness, alongside tightened credit controls. April brought about the first jumbo hike to the official cash rate, OCR, of 50 basis points. And with inflation only getting persistently worse from there, the interest rate trajectory, both actual and forecast, continued skyward. Interestingly, first home buyers have proven a resilient buyer group, likely buoyed by falling values, reduced competition, and emotional rather than financial decision making. They've increased their proportion of sales since March, often at the expense of other owner-occupiers who might otherwise have moved house, as well as mortgage-reliant property investors, who are also facing more stringent credit conditions. Those would-be movers with a less desperate need to buy property or take on more debt, or in fear of being stuck unable to sell their old home, have been more content to stay put. Property investors are dealing with a much less appealing investment opportunity now. Reduced tax write-offs, lower growth expectations, and increased expenses mean they're either unable or unwilling to load up more debt to buy property. Meanwhile, in its latest monetary policy review and statement, Te Pūtea Mātua, the Reserve Bank of New Zealand, went for the expected 75 basis point lift, but noted they even considered 100 basis points. The aggressive tone of the statement was quite clearly designed to send shockwaves to consumers to rein in their spending. There are early signs that people are listening, but the holiday break could prove defining for spending habits. In the statement, most interest was placed on the forecasts. Inflation is not expected to come back quickly, and with that, the OCR is projected to hit 5.5% from the current 4.25%. A recession is now expected, with a gradual increase in unemployment leading house prices to suffer further. Through the forecast recession, the construction industry will remain a watching brief. Increased reports of liquidations, alongside arrears creeping up, will mean potential buyers stay cautious, and the government will be keen observers. Initiatives such as the Build Ready Development Pathway have been designed to provide confidence and certainty to the industry. But after the strong pipeline of consents are worked through, those in the industry will be closely monitoring what's next. It has to be expected that there will be some pain for those heavily funded on debt, but the hope is the industry can get through the tough times and be ready to go again once we get through the other side of the economic downturn. Simply from a housing supply perspective, we cannot afford another bust phase in construction. So then, Going back to our sales volume prediction model, and based on interest rates topping out in mid-2023, wages continuing to grow, and migration further strengthening, we're expecting a minor lift for next year, perhaps hitting 70,000 transactions. This is all very dependent on inflation being tamed, or at least there being signs of improvement, so I wouldn't get too excited just yet. That's pretty much us for the year then. Have a relaxing break, but as always, we'll have plenty of content to ensure you stay up to date with the housing market playbook while you're at the beach. Starting off with our Best of the Best report. Just follow CoreLogic NZ on LinkedIn, Instagram, Twitter or Facebook, and subscribe to the New Zealand Property Market Podcast on all good podcast players. Happy holidays, mā te wā.